Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 36 on November 17th, 2018. I'm your host, Eric, and in this week's show, we will cover trades from last week on Dropbox, Alcoa, and Twitter, and we discuss three new trades this week on Treehouse Foods, Barrick Gold, and BP, British Petroleum. Now, it's always great to hear from listeners, so if you have any questions about the trades presented here or about your own positions, feel free to email me. My email is eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a short video series to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit our YouTube channel, the channel for the Weekly Option. This was a bearish week in the markets. The Dow Jones Industrial Index fell 576 points, ending the week at 25,413 points. The S&P 500 index fell 44 points, closing at 2,736 points. This will also be our first slow earnings week in a while. Of course, the U.S. will be celebrating Thanksgiving on Thursday, so markets will be closed. So this is a short week as well. We will hear earnings from Intuit and Urban Outfitters on Monday. On Tuesday, Best Buy, Campbell Soup, Target, and Kohl will report quarterly earnings. And then on Wednesday, we will hear from Deere and Company. Now, Friday was November options expiration, so all in-the-money options are now valued at their intrinsic value, or basically the stock equivalent value for the option, and any out-of-the-money options that you had are priced at zero. Last week, we looked at a covered call on Dropbox. The stock was trading at $25.55, and we looked at selling the December 26 call and collecting $1.35, hoping for a 7% return in 4 weeks. The Dropbox stock fell $2.28 this week, finishing at $23.27. We collected $1.35 when we sold the option, so that leaves us with a net loss of 93 cents. Since this is a December option, there's still time to make some adjustments to the position. The December 26th call that we sold fell 75 cents. If you were to buy back that option, you lock in the 75 cents as profit, but your net loss becomes $1.53 on the stock. You can then sell the December 24 call, so you're rolling the strike lower. You sell the December 24 call for $1.05 right now. That drops your overall loss to 48 cents. And I got that because you have the $1.53 remaining loss in the stock, and you're going to receive $1.05 when you sell this December 24 call. So if stock goes up to $24, you'll pick up another 73 cents in stock value. So that would leave you with a net gain of 25 cents on the position. Now, that's a lot of action to lock in 25 cents. So you really have to look at overall this stock and whether or not you think it's going to come back or not, and whether it's worth just closing the position out altogether. The credit spread we looked at last week, I made a bit of a gaffe because I must have had travel on the mind, because I called this American Airlines stock instead of Alcoa, but I gave you the correct stock symbol. That's Alcoa, symbol AA, Apple. The stock was trading for $34.36, and we looked at selling the December 35-36 call spread and collecting 30 cents, which leaves us with a possible maximum loss of 70 cents on the trade. Now, Alcoa stock rose $1.59 this week, closing at $35.95. We sold the December 35-36 call spread. I lost money on this trade, but we still have 4 weeks to make a profit on this one. The out-of-the-money spread that we sold now has 95 cents of intrinsic value. You can buy back the spread for 70 cents right now. You can sell the December 35-34 put spread for 30 cents, which cuts your current loss significantly and widens out the profit range, or you can simply wait. I'm in favor of the third option. The price chart still hasn't broken out of the price trend it's in, so it still looks like it's in a downward trend. We're just at the top of that trend right now. It could easily follow the market lower this upcoming week, turning this trade into a winner on its own. So I'm really going to hold out. Of course, if we get to the end of the week and the stock has continued to rise, you'll have some additional thoughts or some additional things to consider, like selling that put spread, or maybe even buying in the call spread altogether. But for now, sometimes I think it's just best to wait, and that's what I'm going to do on this trade is wait and take a look at how the stock for Alcoa moves in the next week. And if it does continue its downward price trend, then no action is good. And if it does continue to rise, if it goes ahead and pushes higher, then I'll need to make another decision, like selling a put spread or buying in this call spread, maybe selling a further out of the money call spread against it. There's any number of things that you can do, but right now I'm leaning towards just holding, because the stock price really hasn't done enough to make me believe that this downward price movement is over. Now, the third trade we looked at last week was a debit spread on Twitter. Stock TWTR, that's Thomas William Thomas Richard. The stock last week was $34.08, and I looked at buying the December 36-35 put spread for 66 cents, looking at a maximum gain of 34 cents or 51% return in a total of 4 weeks. So actually it was 5 weeks. Now, Twitter stock fell 41 cents this week, ending the week at $33.67. That means that our in-the-money put spread that we bought is even more in the money now. So as long as stock stays below $35 per share, we will reach our maximum gain of 34 cents, or the 51% return over the next 4 weeks. So I'd keep an eye on this stock, hoping that it stays below that price. But so far, so good. Of the 3 trades from last week, this one is the only clear winner. The other 2 are losses right now, but I still believe that we have a good shot at them becoming winners, or at least a little bit more neutral. So let's look at this week. Now, the options markets are always a little strange at expiration, because a number of new strikes will be added on Monday, the half strikes. So these strikes don't have any posted prices yet, but I oftentimes like trading the half strikes. So let's say you're looking at a stock that has dollar-wide strikes right now. So be like the December 14 or the December 15 strike, the December 16 strike. On Monday, we'll see the 14 half, the 15 half, and the 16 half. So oftentimes you can find better trades after the markets open on Monday. So consider that for all of this week's trades. These trades are somewhat educational in nature, because I will be taking a look at them again on Monday morning and repricing everything to see what makes the most sense, and finding really the best way to get a high return for the amount of risk that I'm taking. So we'll start off with the covered call. For this week, I looked at Treehouse Foods, symbol THS, Thomas Howard Sam. The stock ended the week at $51.88, and I'm looking at selling the December 55 call for 95 cents, hoping for a 7.85% return in the market. You would enter this trade by buying stock for $51.88 and then selling that December 55 call for 95 cents. This trade makes money if the stock prices stay either above $50.93 per share, which is our break-even price, and then, of course, our maximum profit is reached if stock price ends above $55 per share. Our second trade for this upcoming week is a credit spread on Barrick Gold, symbol ABX, Apple Brian X-Ray. The stock ended the week at $13.04, and I'm looking at selling the December 13-12 put spread and collecting 32 cents. Now, you would enter this trade by selling the December 13 put for $1.52 and then buying the December 12 put for $1.20. This is a credit spread because we are selling the spread ultimately. And this trade makes money if stock prices stay above $13 per share. We're selling the spread, so we want this spread to remain out of the money. Our final trade for this week is a debit spread on BP, British Petroleum. Symbol, of course, is B as in Bob, P as in petroleum. The stock finished the week at $40.84. And I'm looking at buying the December 42.41 put spread for 63 cents, looking at a maximum gain of 37 cents or just a little bit over 58% in 5 weeks. You would enter this trade by buying the December 42 put for $1.92 and then selling the December 41 put for $1.29. This is a debit spread because we are buying the spread. This trade makes money if stock prices stay below $41 per share. That's it for this week's show. Definitely reach out if you have any questions for me or any thoughts on this podcast. Thank you guys so much for listening to me each week. Really enjoy it, and the numbers have been increasing. So if you have any friends that like option trading or want some new ideas for trades, pass the show along. We love to have them have a listen as well. And as usual, if you have any questions, feel free to email me at eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. Happy trading and have a happy Thanksgiving. Take care. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.